We can. So Michael is going to take us through our next session, which Michael's a specialist in intangible risks, and he's going to talk about his latest thoughts in this area. So Michael, I am going to hand the screen over to you, and I will leave you to present.
Thanks, Lauren. Okay, won't be a moment. Now, hopefully everyone can see that.
Yes, we can.
Perfect. All right. Hey, look, thank you again for the opportunity, Lauren, and it's a real pleasure. It's also quite daunting. I'm used to actually presenting in front of people so I can read reactions. So hopefully I won't hear anyone snoring. And to those of you who it's very late in the day, hopefully you've got a strong coffee or morning. And those in late in the day, hopefully you've got a good beer. So I'm going to whiz through this reasonably quickly, and I'm more than happy to take questions, and also we can make the presentation available. So really today's understanding, as Lauren mentioned, is talking about intangible assets, and in particular how you can generate value, but also you can certainly destroy value by not understanding the risks around them. So just to take you through, quick bit of background about Everidge, because some of you who might not have heard about us, we have offices predominantly throughout Australasia. In Singapore, for example, we're in a strategic alliance with the Singapore government, and you'll see in a moment why that is around some of the data. So Singapore has now come out and announced it wants to be one of the leading intangible asset economies on the planet. Not the first time that we've started to talk about this. We've been around now for actually over 13 years, and we work with pretty close to about 1,000 clients, and it's everyone from very, very small companies, in fact, literally people who haven't found often even their first office or hired their first employee, right up to some of the world's largest companies. So there's 4 key things that we do. First of all is helping companies understand what their intangible assets are, and I'll define those in a moment. Once you know what your assets are, then you can start to identify what the risks are around those assets, and of course try and either remove or reduce those risks. The third area is quantifying the value of those assets. In other words, understanding what the potentiality of those assets is worth. And the fourth is actually executing on that. And typically intangible assets are worth more in big hands than small hands. So some of the clients that we've worked with, you'll know some of these brands. For example, in the US, people like Comcast, Coca-Cola, and unfortunately, a lot of our really cool brands you've just never heard of. In other words, those clients haven't scaled yet, or they're in the process of scaling. So let's get into intangible assets. So this is the first data point that I'd like to give you. So this is the S&P 500 over the last 40 years. So as you can see, 1975, intangible assets only accounted for around 82% of the value of the S&P. Sorry, tangible assets. The remainder was intangible assets, or back then as we called it, goodwill. So 2 things happened in the 80s and 90s, and this is really relevant in particular for Western economies. So remember, this is a US exemplar. So you see US companies, in particular in the 80s, offshoring their manufacturing, in particular to China. So in other words, they picked up the plant, the equipment, the machinery, the what. But when you transfer the what, you also end up transferring the how. And this is where, unfortunately, we start to see what were yesterday's suppliers becoming today's competitors. And one example of this is that it's not like Huawei just woke up one morning and worked out how to do 5G. They got taught by their former clients, being Ericsson, Nokia, AT&T, and Bell, etc. So you now see well over 90% of the value of the S&P 500 sitting in intangible assets. So in other words, the yellow. The way that you work out this figure, for those of you who would like to do it, in particular if you've got a listed company, if you take the market cap, less the fixed assets, the debt and the cash, the only thing that is then left is the intangible assets. So the area where Everidge specifically focuses on, and we're going to be talking about today, is the yellow. And that's because it's the predominant asset class today. So let's first of all get everyone using the same understanding. So whilst I use the term intangible assets, ultimately what we're trying to describe is how you can generate margins and/or market share. So if I'm a CEO, I might call it a competitive edge or an unfair advantage. As I mentioned before, accountants typically call it goodwill. If you go to a patent attorney, they'll call it IP. Warren Buffett, for example, in his documentary refers to it as moats. And if I go out to the manufacturing sector, which are typically seen as, non-techie, or they might not have intangible assets, they do, but they call it secret sauce. And remember, ultimately, it's about how are you going to generate that margin and or that market share. So we can then break intangible assets down into a number of different buckets. So again, if I go and talk to a patent attorney, for example, they'll want to talk to me about patents and or trademarks. Now, the majority of the value we actually see sitting in companies sits in confidential information, systems, processes, regulatory approvals. And of course, where you see the major assets sitting, e.g. confidential information, these are also the major sources of risk. And I'm going to talk about risk just in a little while. So I mentioned manufacturing companies before. So here's one example. We were working with a client. They had 85% of the market. They were the dominant player. I remember bringing this slide up in front of the client. And at this point, all of a sudden, we had their entire senior management team in the room. This was a $200 million manufacturing business. It had been acquired by a large private equity firm. Big Four legal, Big Four accounting had gone through and had not identified any material risks. At this point, one of the senior managers at the end of the table starts going absolutely crazy on his keyboard, typing away, to the point where the CEO interrupted me and said, "Hey, Michael, I don't think you realize what you've just pointed out to us, but you've just identified that all of the value sits in our bill of materials." I said, "Yeah, that's not unusual. You're a manufacturing company. Of course, it's got all your backward orders, your forward orders, how many man hours go in." Essentially, it was the blueprint to how they ran their business. Now, this company took physical security very, very seriously, to the point where they had literally, guards and razor wire. And we just highlighted that their main asset, their bill of materials, was vulnerable. And the reason it was so vulnerable, as the CEO said, is all of our 200 staff have full read, write, and delete access to that information. And the information was literally sitting in an Excel spreadsheet. One of each was on their 15 sites throughout Australasia. And the guy down the end who was tapping on his keyboard was their IT director, who was locking the information down. At this point, there was a fair amount of disagreement that broke out amongst the management team. And it was around, if one of those spreadsheets had got to one of their competitors, how long that company would have existed. And the agreement came to they wouldn't have existed for more than 6 months. So this is the major asset of the company. It's not on the fixed asset register. It's not on the balance sheet. And for the most part, it wasn't recognized as an asset until we pointed this out. And it was probably the biggest risk to the business in being able to disrupt their ability to continue to perform their operation with their tangible assets. And what you then find is it's just orders of magnitude more if you go into an e-commerce company. So if I take you through a couple of examples. So the first one is Instagram. So for those of you who might not know the story about Instagram, so Instagram had $0 in revenue. In fact, that is the 12 staff of Instagram right in front of you. And they'd only been going for 2 years. Now, they got acquired by Facebook for $1 billion. Now, ironically, on the exact same day that Facebook buys a company with $0 in revenue for $1 billion, you've got a company like Mainfreight, who are one of the world's largest transport companies. $1 billion in revenue, $2 billion in assets. This is a significant business. Guess what? Worth $1 billion. And you say, well, how is this possible? And the reason being is that tangible assets can't scale at an exponential growth rate. Only intangibles can. And here's some examples of how long it took these companies to get to $1 billion market cap. So it took someone like Harley Davidson 86 years, yet it only took YouTube 1 year. So what you then find is that the board, the C-suite, the investors, first of all, don't understand what assets they own. They're intangibles. If you don't understand what the asset is, then you can't identify what the risks are. Third is that it's then near impossible to be able to link those assets back to the financial results. And then fourth is, how do we then generate value from those assets? So I'm going to talk very quickly now about how intangibles increase value. So typically you will find that the inverse of risk is value and vice versa. Now, by the way, I'm going to be disagreeing with what I just said shortly, and I'll explain why. But let's just focus on how we create value through intangibles. So this was one example. I'm going to use some case studies now. This company had been going for 30 years. They went to their traditional investment bank because they wanted to do an exit, and they got told they were worth 4 times EBITDA, so 4 times their earnings essentially. What was interesting is that we got brought in at the 11th hour. We looked at the balance sheet, we looked at their fixed asset register, and there was nothing really there. What we did identify though is they had a 30-year-old, well, they'd created a data set over the preceding 30 years. That was the main asset of the company, it turned out, because they were sitting on the periphery of the insurance industry, and essentially it was actuarial data. So we said to the iBank, well, what about the data? And they said, no, look, we've looked at the data and it's going to be a trade buyer, and the trade buyer's either got the same data or better data. So that's a fair point. What about other industries? They said, no, we don't think anyone else would want this asset. We ended up identifying 4 other industries that would want that data, and that company ended up selling for 32 times its earnings. So in other words, it was an 8-fold increase on what the traditional approach to valuation said. Now, in this instance, it's an upside risk. In other words, if they had exited for 4 times, the risk was that they didn't maximize the value from that business. This next one quickly, this was a JV entered into by a dominant player in Australasia. They essentially had maximized their share price. The only way for them to increase that was through expansion into the US. Both parties went to their respective Big Four, who identified it was a $50 million JV, and they recommended that each party put in $25 million of cash. The Australasian company, who was our client, said, look, something doesn't feel right. We think we're contributing more by way of our intangibles. So we said the only way to determine that is you do a valuation of what the other party has, what you have, and you work out what the differential is. We did exactly that, and we ended up identifying that our clients' assets were worth more than the entire deal. As a result of presenting that valuation to the other party, they accepted that, and our client ended up only putting in $3 million of true goodwill into the deal, and it ended up saving them $22 million in cash. Now, of course, they also contributed their intangible assets as well. So again, the risk in this situation was that if they just put the cash in, it would have cost them $22 million. So the traditional approach to valuation is really about valuing the fixed assets and the cash, which is how you generate cash flow. And it's almost mechanistic. It's a bit like riding a bike with only one gear. So the only way you can increase that value is through strategic value, and it's the intangibles that drive that. But getting down to the second part is it's typically the greatest area for risk. In other words, it's the easiest way to reduce the multiplier or the quantum paid for the company. So let's get on to the risk side. So the 5 biggest risks that we see in pretty much any of the work we do is, first of all, most companies don't leak a little bit, they leak a lot. Second is they can't even prove they own their assets. 3 is that we see a huge amount of open source, and open source has its own risks. 4 is they unfortunately often don't own their brand in a way that they think they do. And 5, if they go anywhere near the US, it's not if we'll be sued, it's when. So I'll give you a couple of quick case studies. This first one, this company had created a completely game-changing product. In fact, they ended up owning the product category. They were growing so fast, they couldn't hire enough engineers. So they ended up finding some German software coders. The German software coders, in fairness, delivered the product on time, on budget. Unbeknownst to senior management, they just saw that their own internal software team had developed the asset. They went to do version 2. So the engineers went to find the German software coders, and of course, unbeknownst to management. It turned out that they couldn't find the German software coders, who had turned up 6 months later as the major competitor to this company. In fact, not only were they the major competitor, but they ended up running the original company out of the market, and ended up costing that particular company $150 million through dissipation of that market. The second is chain of title. So this was a company, we were asked to get involved through the investor, and a standard warranty on an investment is, can you prove you own your assets? When we tried to work with the company that was being invested into to try and prove their assets, we couldn't actually determine that they ended up having chain of title. By not being able to confirm they had chain of title, unfortunately then precluded the investor from investing, and then as a result of that, the company ended up falling over. Again, basic premise is you need to be able to prove that you own your assets, and it's very difficult, in particular around things like software. 3, we talked about brand. Unfortunately, most companies we come across, we find they don't own their brand. So this was a very, very large Australasian company. They were spending $1.5 million on marketing each month to build their brand. And the plan was they were then going to leverage their brand to expand into their offshore market. Now, unfortunately, there's two components of a trademark. The first is what's called the word mark, which is where you own the word, for example, strategic risk. The second is the device marks. In other words, the visual representation of that logo. So with McDonald's, it's the golden arches. This particular company, unfortunately, had never filed their trademarks correctly. And more importantly, they didn't understand what they owned. They only owned the visual representation of their brand in their own market. They didn't even own the word mark of their own market. Unfortunately, it turned out that their competitor, or their main competitor in the US, owned not just their word mark, but also their visual representation. So what that meant is that this company had spent $36 million building a brand that it could never own. Now I want to take you through a little bit of a challenge on risk. And the parallel I want to draw you to is stress. So we all know, or you may or may not be aware, that there's two kinds of stress. There's what's called distress, and the other is eustress. So distress is bad stress. And typically if you say to someone, eustress, you're talking about distress. And it's typically the source of anxiety and unfortunately depression. The other side of stress is eustress. So eustress is literally what got everyone to listen to this call and out of bed this morning. And it's what motivates you. So I want to apply this across to risk, because if you think about it, the day that every single company on the planet started, they were taking the maximum amount of risk. And the reason for that is because they start with no revenue. And so typically they're running at a negative profit margin. What happens over time though, is of course it gets de-risked as revenue goes up, and you find the risk curve goes down. And what you also find though, is that margin initially goes up, but then it tracks down over time. In other words, this is a steady state. And there's a reason for this. And the reason I've called this the risk dilemma is because how you start is often not how you then continue the race. So I'm going to talk you through what I'm talking about here. And I'm going to introduce two new concepts. The first is this concept that there are two kinds of risk. There's a negative risk and there's a positive risk. So if we take disrisk first, this is the traditional view that we have of risk. It's normally seen as reactionary. It's normally the reason why you don't do something, or it's about how you can reduce costs, for example, and it's often compliance driven. However, if you think about it, every company typically starts with a huge amount of risk, and it's normally about how you create opportunities, how you be innovative. It's creative thinking, and really it's about how you create growth ultimately. And what you find is that it's actually risk, risk in particular, that is driving true innovation. And if you think about it, disrisk is normally seen as a negative, and ultimately it results in a decrease in profits and a decrease in that return on investment. Risk, on the other hand, which is how people like Henry Ford and GE and a whole bunch of others created their business, is they see an opportunity. They use it to drive growth, which drives up profit, which then drives up your ROI. And one way to look at this is that your disrisk is where others will find opportunities. So in other words, where you're seeing a negative, others will often see a positive. And this is exactly what Uber did with the taxi industry. What the taxi industry's disrisk was Uber's risk. So happy to take some questions about that. So just to summarize, what I've put together is a list of some of the questions you might want to ask internally. And not surprisingly, the first one is, well, what are our intangible assets? And importantly, who's managing them? The second is, what's our strategy? Does it actually align with what the business strategy is, and in particular in capital raising? Third is, well, what is our level of understanding and management of our intangible asset risks? And in particular, is it a strategic or a tactical risk? Is it a U or a dis risk? And then, are the people that are giving you the advice around in particular your risks, or the business, benefiting from that? And the other side, of course, is, are we able to explain the value in our business, which we know is not in our balance sheet or our fixed asset register, but it's in our intangibles, to an external party? The other area in terms of advisors is, have they actually done this before? Are they operating experientially or just theoretically? So in terms of the areas that boards and companies really need to focus on, this Four key ones. As I mentioned before, what are our intangible assets? Second, what's the strategy around them? Third, have we actually identified what our not just our dis risks are, but also what our U risks are? And then fourth, what's our strategy around those risks? And here's the bad news. If you're an officer or a director of a company, under most countries' companies law, you have a basic fiduciary responsibility to manage and protect the assets of the company. And I would argue that if you don't know what your assets are, and in particular if they typically account for 90%, then you're failing in that responsibility. So look, more than happy if you'd like to get in touch with us, we can provide details. But Lauren, hopefully I think I've made it just under 20 minutes. So well.
Well done, Michael. That's very impressive that you kept the time. Interesting. So obviously for context, Michael's, I know about Michael and intangible assets, but the dis risk and the U risk is something new to me. Michael, how if risk managers are leaving today or starting work tomorrow morning, where do they start to approach this within the business? How do they start the conversation on dis risk and U risk matter?
Yeah, well, they say that awareness is 98% of every problem. So I think the first thing that I would do if I was going to an organisation is, again, just work out that first point I made is what even are our assets? The one thing is that, you know, if I walk into any organisation and I look under the boardroom table, I'll see a little sticker on it. There'll be a sticker underneath the conference phone. Someone will come around once a year and make sure that that's there. It's recorded on an asset register. There's normally insurance, ironically, on those fixed assets, and audit will even go and make sure those fixed assets are there. Yet that's not where the value is. So it's about identifying where are the intangible assets, and not just where they are, what they are, but also who's responsible for managing those assets. And the bad news often for the chief risk officer or the chief finance officer is normally it's sitting under or the CEO is normally thinking that this is under their remit. And having spoken to a number of chief risk officers, this is normally not even on their radar. You know, they're typically focusing on, you know, from the conversations I've had anyway, on typically the dis risks. Now, the dis risks will obviously decrease value, but really the real opportunity, I think, in particular for the CROs on the call, is this is an opportunity to really get risk, you know, back into the boardroom and the C-suite conversation as a positive. And as one CEO recently said to me, you know, when I see my chief risk officer coming towards me, it's like Darth Vader or the Grim Reaper. They're normally coming at me with bad news and telling me that we've either just been sued or something bad's happened and it's about to cost us a lot of money. This is really an opportunity, I think, for the chief risk officer to start up a secondary conversation about U risk and about how risk can really drive that true innovation inside a corporate and create, you know, not just short-term, but long-term value and growth.
I actually asked this of Chris Corliss, who was on the last call, but I think it's a good question for you as well. What's your vision for risk management in, say, 10 years' time? And do you think the ideas you're talking about will have stuck by then?
Wow. Yeah, look, I think, you know, if I had my magic way, I hadn't thought about this, Lauren, good question. I would hope that there's a dis risk manager and a U risk manager reporting to the chief risk officer. In other words, that they're seen as almost potentially individual departments, because, you know, dis risk and U risk are very different forms of risk. And I suspect that they're also slightly different personalities. So I think also not just having that at a management level, but also that the traditional approach is to have an audit and a risk committee. And again, it's seen as a very negative committee, and normally it's not a fun committee. You know, I think really where I'd like to see that is that that's again split out, and certainly at board level that there's a committee focusing on the U risk. You know, how are we going to create growth? It's not to say that you might still not have a dis risk committee, but that really companies should be thinking about growth. If I go back to that earlier slide, every single company on the planet started as someone with an idea, and they were taking the ultimate amount of risk that the day they took that. And fortunately or unfortunately, depending on how you look at it, as they grow, they take less and less U risk because they focus, I think, too much on dis risk. In other words, what's going to go wrong rather than looking at what's going to go right. And this is typically where you find, you know, disruption happens. I mean, Nokia had their most profitable year the year before they went under. I think Kodak was almost the same. Those boards and management, I suspect, were focusing purely on dis risk, not on U risk.
Now, is there any low-hanging fruit? If somebody wants to sort of start tomorrow or next week, what should they start with in terms of dis risk and U risk?
I think it really comes back to the size of the company. I mean, if you're a scale-up company, you're probably almost, in some regards, focusing a little bit too much on U risk because, you know, that's the part of the curve you're on. If you're in the middle, it's maintaining that balance. And unfortunately, typically, the bigger the company, the less or the more they focus on dis risk and the less they focus on U risk. And this is, again, really where I see it as an opportunity for the chief risk officer to really reset the narrative, not just with their fellow members of potentially the C-suite, but in particular the board. This is a new conversation to have, and certainly the board members that I'm aware of and the boards I'm on, we all are looking for how we create growth. Now, I think hopefully it goes without saying, I'm not saying bet the farm. I'm not saying put the entire organisation into the U risk category. You've still got to focus on dis risk, but you want to make sure that you're not ignoring the U risk and that you are still taking those positive risks and you're looking for that true innovation. So I think depending on the size of the company is probably where they're at on that curve.
Awesome. I will leave it there. Thank you so much again, Michael, for your thoughts as always. And I really encourage everyone to get in contact with Michael and the team at Everedge because they're consistently really good at this type of thing. So they're certainly there for your assistance. And I think you can find you on LinkedIn, etc. as well, can't they, Michael?
Yeah, no, look, absolutely. And look, thank you again for the opportunity, Lauren, and the team at Strategic Risk. I hope people found that of interest. You know, by all means, reach out to Laura and I if you've got questions around this. But the one thing I can tell you is that if you're not worrying about the stuff that I've just talked about, I can assure you your competitors are. And that's probably the big risk, is just hoping this stuff's going to go away is probably not a great strategy. As you saw from that first graph, intangibles are ever increasing as a more and more dominant asset class. And if you're not measuring it as Drucker says, then you can't manage it. So the first step I would take is just work out what those assets are. So thank you again for the opportunity, Lauren.
Thank you. We now are taking a break and we'll pick it up at 6 p.m. Sydney time, 3 p.m. Singapore time, and we should pick up some London audience as well. Our next presenter is Suchitra Narayanan, who is our Strategic Risk Manager of the Year, actually. And she's going to be talking about selling the value of risk management to your board. So you can either hang on the line or pop back at 6 p.m. We'll see you then. Thanks.